Hello friends. India from 1991 onwards showed a sharp increase in economic growth due to the economic reforms introduced by the Indian government. The economic reforms included liberalization, privatization, and globalization. Liberalization led to the transition from a mixed economy to a market economy. Privatization led to the sale of public sector undertakings to the private sector, and globalization resulted in the integration of the Indian economy into the world economy. Liberalization and privatization laid the groundwork for globalization in India. In India, the BSE stock market Sensex, which was showing around 2000 points on January 15, 1992, rose to 20,000 points on October 29, 2007. There was a sharp rise in the industrial growth and the overall standard of living of the ordinary Indian middle class society, which showed a change for the better. This resulted in the influx of huge amounts of money from foreign institutional investors into the Indian stock market, which resulted in a further rise of the Sensex. The economic reforms introduced by the Indian government facilitated globalization. It resulted in foreign direct investment, capital inflow, and increased transfer of technical know-how and wider markets access to India. Before globalization, Indian consumers were restricted to access to goods produced within India itself. The Indian consumer had access to foreign goods only through the import of these goods during those days. Today, soft drinks like Pepsi, Miranda, and Coca Cola can be enjoyed by an ordinary Indian, just like any ordinary individual in the USA or other countries. This was because such companies could easily establish soft drink plants in India and produce these soft drinks in India itself, which was affordable to an ordinary Indian customer. Famous hamburger outlets like McDonald's, which existed only in foreign countries, and eventually sprung up in different places in India. Foreign companies can now hold equity shares of Indian companies. Thus, one can see is that there is an interlinking of different world economies with the advent of globalization. If there occurred a financial collapse of one particular country's economy, this would affect the other country's economy as well. In a free market economy, the price of a commodity is determined by the law of demand and supply. There is only a limited amount of regulation by the government, and that is in ensuring that the legal system is maintained, property rights are protected, and making sure that there is no use of private force and that no fraud is committed. India followed a mixed economy before the economic reforms in 1991 in the sense that there was a mixture of a free market economy and a planned economy. As stated earlier, due to liberalization, there was a transition to a market economy, which was where a free pricing system was put into operation. In mixed economy, the pricing system is not entirely free in that the central government had a reasonable degree of control in determining the prices. That does not mean that the market economy is another nomenclature for a free market economy. A market economy does have a socialist element to it, unlike a free capitalist market economy. A mixed economy has a mixture of socialist and capitalist traits in somewhat equal measure. A free market is only a theoretical concept. No economy in any country of the world has a pure form of free market economy. There are varying degrees of free market dynamics in the economies of different countries. In a planned economy, the pricing system is entirely governed by the central government. However, a few countries have planned economies today, like Saudi Arabia, Cuba, Iran, North Korea, Vietnam, and Burma. The global recession of 2008 was nothing but an adverse reaction to the negative impacts of free market policies, globalization, and capitalism put together. As I mentioned before, due to globalization, there's an interlinking of different world economies. When the richest economy in the hierarchy collapses, so do the other economies which depend on it. That is exactly what happened in the global recession of 2008. The signs of the global recession started in the USA before the year 2006 when a good deal of foreign funds were flowing into the country. Around that time, some people in the USA found it easier to enter the real estate market, especially the housing sector, to make quick money. Since credit conditions were favorable, then ready loans were available to buy the houses. As people began buying and selling houses, there occurred a boom in the housing sector. This made other people who were not previously in the real estate business to enter the field. Thus, the demand for the housing loans began to increase day by day. But the banks in the USA usually do not give loans to customers with low credit worthiness. Some greedy financial institutions saw that as an opportunity to increase their business and cash in on the housing sector boom. Therefore, these financial institutions with good credit ratings approached the banks for loans, which would be eventually divided into smaller portions and given as home loans at higher rate of interest. Usually, the financial institutions check the loan repayment capacity of the potential borrowers before they sanction the loans. However, in case of the housing loans, they ignored this common practice and began sanctioning housing loans to as many customers as possible. Not only this, but to widen their loan disbursement reach, they lured their loan agents with huge bonuses and incentives. Thus, people with low income and bad credit history were given these loans. These types of loans were known as subprime loans. There is another type of loan known as prime loans, which the banks directly lend to credit-worthy customers. Due to the housing sector boom, more and more houses began to be built. Thus, there was a surplus number of houses in supply, which was inconsistent with the demand. As per the law of the demand and supply, when supply increases inconsistent with the demand, the price decreases. Thus, the value of the houses began to decrease. This happened sometime around the year 2006. Hence, the people started to feel that the housing sector was no longer a viable investment. Also, the people who took subprime loans started to default on their payments. This was because these loans were taken by the borrowers at a floating rate of interest, which means that the interest rates on these loans was not fixed, and when the US Federal Bank increased the interest rate, which was of course previously lower, the subprime loan interest rate also increased, thereby leading to higher EMIs than the loan known as prime loans, which the banks directly lend to creditworthy customers. So these financial institutions started initiating legal proceedings known as foreclosures to repossess the property that was put as a security against the subprime loans. However, these financial institutions were in for a shock as they found out that the subprime loan amount was higher than the value of the house, which was placed as a security. Thus, the borrowers of the subprime loans found it wise to forego the houses than to repay the subprime loans. Had this been a local matter between the subprime loan borrowers and the lenders, that is, the financial institutions in the USA, then the economic collapse would not have affected the rest of the world. Now, let's see what is before the collapse, what happened. The subprime loans were considered to be a lucrative investment by the lenders. This was because the subprime loans were charged with an interest rate of 2% higher than the prime loans because of their risky nature. As long as the borrower of the subprime loans continued to pay their interest, the lender would continue to have money coming into his pocket. Also, if the subprime loan borrowers defaulted on his payments, the lender would have a good option of selling off the mortgage house since the homes fetched a high market value then. During that time, the US stock exchange was booming with many foreign investors and the mutual fund investors also pumping in their money, thus increasing liquidity in the market. Even before the subprime loans, uh, which is concerning the interest, were completely repaid by the borrower, the financial institutions started converting these subprime loans into financial securities and sold them to big financial institutions. These securities were known as in the market as mortgage backed securities, in short, MBS. Most of these big financial institutions were American and European investment banks. The EMI paid by the subprime borrowers, or rather subprime loan borrowers, were passed on to these big financial institutions. This was the way these investors benefited from their stake in the mortgage backed securities. The money got by selling the mortgage backed securities to big financial institutions was used to repay the loan that the financial institutions lending the subprime loans took from the banks. Since the loans taken by the subprime lenders were not defaulted in any manner, more loans were sanctioned to the subprime lenders, who are the financial institutions. Thus, more subprime loans were given and more securitization, which means converting subprime loans into securities, was done. This process continued until the subprime borrowers started defaulting on their EMIs. When this happened, along with the real estate prices crashing, the value of the mortgage backed securities started declining in the US stock market, that is, the Wall Street. The subprime lenders now could not repay the loans they had taken from the banks, so they tried to take loans from other financial firms, but they were not ready to help the subprime lenders as real estate prices were decreasing day by day. Thus, the subprime lenders, the big financial institutions which bought the mortgage backed securities, and the banks that gave loans to the subprime lenders, all of them started recording huge losses. Due to these losses, global banks and other financial institutions had to write off something about $500 billion. dollars. The largest blow was suffered by the US banks, next, the European banks, and the least by the Asian banks. All this resulted in a chain reaction of panic. Since banks were the major source of investment capital and loans for industries and other businesses, this decline in net capital of the banks resulted in lack of cash for performing their business. Due to the global recession of 2008, the Indian stock market fell, the rupee weakened against the dollar, and there was extreme shortage of liquidity in the market as the Indian banks faced a cash crunch. As stated earlier, due to the economic reforms introduced by the Indian government, there was a boom in the Indian stock market. This was chiefly due to the foreign institutional investors, who are the FII. These FIIs were the ones who would eventually lose substantially due to the investment in mortgage-backed securities and due to the subprime crisis in the US. To maintain a fixed proportion of the investment in the US, they had no other option but to sell the investments in India and other emerging markets. From the beginning of 2008, the FII began to withdraw from the Indian stock market. The FIIs had to get back the investment in dollars. So there was a huge demand for the dollar against the rupee, and the rupee started to fall against the dollar. Since stock markets and external borrowings were the important sources of raising money for the industries in India, the stock exchange collapse in India affected the growth in industrial activity a great deal. However, the great relief was that the major banking operations in India were under the control of public sector banks that were very vigilant and risk averse. Hence, the subprime crisis, which badly affected the US banks, did not affect Indian banks to a great extent. Although there has been a presence of big US and European banks in India, and even some Indian banks like ICICI had some foreign subsidiaries with a stake in the subprime losses. Overall, there was not a thing of much worry for India. Due to the global recession of 2008, there was a reduction in the demand for consumer goods worldwide, and also India's exports drastically came down compared to the previous few years. The subprime crisis gradually spread to all business sectors all around the world, just like a pandemic. The most disturbing thing of the global recession was the loss of jobs worldwide, and India was no exception. Thus, one can now conclude that the reason for the global recession was due to the negative impact of the market policies, capitalism, globalization, and the greed of some financial institutions, mainly in the US, which lend money violating ethical lending practices. There was no doubt that the recession would fade away, but of course, it has made everyone much wiser and prudent than ever before. Please press the subscribe button and also don't forget to press the like button to help me make such informative videos in the future.